Welcome back to Financial Strategies with Andrew Adjemi in Connecticut and Daniel Adjemi in Colorado.
So I was talking to Rhonda and Joe. They came in for a free retirement analysis and preparedness analysis, a second opinion. And when I was looking at their portfolio and saw that they had a bunch of mutual funds in their portfolio and that sort of thing, and I asked them, are you conservative investors at this point in your life or aggressive in your investment style? And they said, well, we're conservative now that we're older. We used to be a lot more aggressive when we were younger, but now that we're older and we're close to retirement, we're much more conservative. And I asked them their definition of conservative, because different people have different definitions. And I said, here's your definition of conservative, meaning that you don't want to lose any money? And they said, yeah, but we want to make money. I said, well, everybody wants to make money. But it's just, but you don't want to lose money. That's your definition of conservative, right? And they said, yeah, that's right. And I said, okay, so how much, what percentage of your portfolio do you think you should have at risk in the stock market right now? And they said, well, we think we should have maybe 10% at risk in the stock market right now. I said, okay, all right, well, that's a good number for, you're 63 years old. And that's probably a good number for this point in time, because you want to make sure that you don't run out of money. So I looked at their portfolio. I said, okay, now looking at your portfolio, you have any idea how much of your portfolio actually is at risk right now? And they said, no, Andrew. What is it? I said, you're actually 90% at risk right now. And they said, we're upside down. We only have 10% safe. I said, yeah, you only had 10% conservative. They said, well, how could that be? Our financial person said, said that we're set up conservative. We told them we were conservative, and they said we're set up conservative. I said, well, that goes back to their definition of conservative. Generally speaking, they're stockbrokers. And stockbrokers are aggressive by nature. I mean, if we were back in high school and we said to the guidance counselor, hey, what do you think? We're conservative people. What do you think we should do for a living? You think they say be a stockbroker? No, they say be a clerk, be a doctor, be a nurse, be a mechanic, whatever, right? But they're aggressive by nature. So their definition of conservative is a totally different definition of conservative. And their definition of conservative is you can still lose money. Like that definition that Daniel said earlier about the bike, that is safe as long as you do these kinds of things. And that's why we're talking to you today about risky business. I'm Andrew Adjemi.
I'm Daniel Adjemi, and you're listening to Financial Strategies. We're talking about risky business today because risk is a very important thing for investors to understand. There's different types of risk, and you want to make sure that you are taking on the risks that you are okay with. And you need to understand those, or understand the questions to be able to ask to make those choices, and to take on those things, right? Right. In that bike scenario again, right? Right. If you say, well, this is crazy. This bike is way more risky to take. I don't want something that I can't go more than 5 miles an hour. And you walk out and you see you're at, secondhand, turned in for free used bike store. Then you start saying, oh, I get it. They could only offer me that one thing. That's all they had. And so you have to start wondering, is the advisor, is the institution, is the company that I'm working with, are they able to offer me more than this one cookie cutter bicycle? This one cookie cutter, investment strategy, or are they able to offer everything, that customization based upon, the things that are important to me and the goals that I want to have? We don't meet anybody in here that's goal is to worry about running out of money their entire retirement and have to scrimp and save, right? We encourage people, you're earning this income, you're earning this interest. Now go live life, go have fun, go spend your money, because it's interest coming in for you. And we encourage people to do that all the time here, because that should be what retirement's about, is finding new hobbies or doing the hobbies that you love and not having to worry about paying for those. Hobbies are expensive, but use your dividends to pay for your hobbies. Don't use your own money.
Right.
So you have a whole list of different types of risk. And a lot of these people, like in your story, they don't understand those. They come in and in your story, they told, I want 10%, 10% like crazy risk in the markets that I don't really know what's happening to. And the 90%, I want somewhere moderate or in safe.
Right.
And so what are some of these risks? Should we go through some of them, or what do you think?
Yeah, yeah. Let's just rattle those off. Okay. So first, there's interest rate risk, which you talked a lot about earlier, right? And CDs today are paying 1% for a 5-year CD or whatever, as
I don't think
opposed
you
to
can get that much right now.
well, maybe not, right? But they're super low, right? So you put it in a CD, then the question is, well, what's the rate going to be later on? And then there's market risk, and the stock market goes three directions: up, down, and sideways, right? And so if you need to take your money out, market risk is something that's very significant, because if you're taking it out when the market's going sideways or the market's going down, you're actually cutting it into principal, and that's not good. You're killing roosters at that point in order to get your money. There's inflation risk, which we really hit upon, and just look at gasoline and how much it costs today, how much a car costs today compared to when you were in high school, and that sort of thing. Then there's the business risk, which we talked about kind of with Delta Airlines of not flying as often and not taking as many passengers as often. So there was a risk there with the business. And then there's the financial risk, which again, with the Delta Airlines, and they were a good company financially at the beginning of COVID, but then they spent all their money during COVID, so that they turned into a higher financial risk. And that's why we ended up selling them. Then there's liquidity risk. And some people need money, but the one thing is, right, is that people think, well, I need $1 million at retirement, 2 million, 3 million, whatever. No, you don't need 100% of your money available when you retire, right? What you need is the interest and dividends off it, maybe up to 10% per year. From that standpoint, you don't need all. You're not going to go out and spend all of it, but liquidity is something that's significant. And that's why people don't, in the old days, when they were getting 10% on a 5-year CD, they would think twice about putting it in 5 years, because even though they're getting 10% at 5 years, decades ago, right? That the question is, what are they going to have to pay to take it out? And then there's exchange rate risk. Daniel, tell them about exchange rate risk.
Well, exchange rate risk can work positively for you, or it can work negatively for you. If you're purchasing, a Rolex in the US, and that costs $25,000, or you go to, say, another country, you go to Switzerland, and the exchange changes, that Rolex could cost you 30,000 US dollars in Switzerland, because you have to exchange your money for the Swiss franc,
Right.
or it might only cost you 20 in US dollars. And so sometimes it's good to have other currencies in your portfolio, because if everything's US dollar and the US dollar starts, um, losing purchasing power, that could protect you.
Right.
But you have to understand, how much you want in that and those kinds of things. But that's exchange rate risk.
Right. Good. Thank you, Daniel. And the big question, the big thing is ask questions. If we're not, our goal here is to at least be able to give you and our listening audience information, so that you can at least know the questions to ask to find out how much risk that you are actually undertaking, and is that what you want to take. Good business owners, they don't know everything, but they know the good questions, and they ask a lot of good questions. Then there's also systematic risk, which is, the aspect of not being diversified properly. And so a lack of diversification can really give you things. And some people, they buy all kinds of mutual funds and they think they're diversified, but that's a problem, because there's also the risk of lack of correlation, because you want things that are going up when other things are coming down, and vice versa. And that's why they say that bonds are safe compared to stock, because many times when stock is going up, bonds are going down. But when stock market is going down, bonds are going up a lot of times. But bond funds don't do that. Bond mutual funds don't do that. Individual bonds do. And that's why the correlation there with gold as well, right, Daniel? And Bitcoin and so forth.
Yeah. Yeah, that's a really big thing. Um, and to make sure you know how you're purchasing it, because that's another layer, right?
Right.
The way you're purchasing it. So if you're purchasing, um, corporate bonds through a fund, the difficulty is, one, there may not be somebody picking those investments based on valuation or fundamentals. They might just be saying we have to buy triple B or higher,
Right.
and then there may be a company that's not really triple B,
Right.
but the rating agencies haven't downgraded it yet. So that ends up in the fund. And then when the rating agencies downgrade it, they have to take it out. So what do you think happens, right? What does the listener think happens if a bond gets downgraded? Well, would you want it as much if it was
No,
investment grade,
nobody does. It's like your credit
and
risk is
now it's
high.
not
Yeah.
investment grade? Then what happens? Less people want it, and with supply and demand, it becomes valuable. So if it was trading at 108, right,
Right.
and it got downgraded, it might trade at 94. So you just lost money, and then you know what happens? Instead of holding that to maturity, because maybe it's not that big of a deal, you owned it anyways,
Right.
and maybe it's not that big of a deal. You have to look at the fundamentals to know, but they're mandated to sell that because
Uh,
it got downgraded. So you
right.
lost money on a bond, when the whole purpose of bonds is to give you that extra layer of security that on X date you get your principal back and you collect interest in the meantime. What you really want to do is you want to find those bonds that might be one notch underneath investment grade. Think about a credit score, right? If your credit score is 700, right?
Right.
And the bank says if you go to 699, your loan goes from, we'll give you a 4% rate if it's 700 or higher, but we're going to give you a 7% rate. We're going to charge you 7% if it goes to 699.
Ouch.
So this is like the bonds. If you have a 699, you might be able to earn 7%. It's one number below the 700, right?
Nice. Right.
And you want to find a company that has a good outlook, so they actually get upgraded to that 7,
And you're still
and then
making.
it'll start trading at that 4, which means to you,
Yeah.
your bond, you collected the 7% until they got upgraded,
Right.
and now it's trading up above par, and you have the choice to liquidate it if
And
you
you make
want
some
to, or
money.
you could keep collecting the dividends.
Nice. Nice. That's sweet. Well, then I'm also thinking of the other risks in regard to like, not having a fiduciary. That's risk of somebody that's not working in your best interests on that front. There's a risk of, thinking that, just somebody has the designation, certain designations after their name is going to be somebody that is the best person for you as well, because that doesn't necessarily mean they have experience. That doesn't necessarily mean that they do it. That just means that they've got an education. They're smart people, and that's all good. But experience and actually specialization is important as well. Well, boy, we're running out of time. I see we're at the end, and we're going to need to take a break. I want to let you know in our listening audience, we have a paper to go along with today's show called The 7 Risk of Your Retirement. 7 Risk of Your Retirement, to be able to help you understand some of those other things that are between the lines that we're talking about today. Then we also have the book Financial Insanity. To the next 5 callers at 800-725-7616, 800-725-7616. And all we ask in return for the book, we'll send it out to you free of charge, except all we ask is that be able to have a 10-minute conversation with you, getting your ideas about the book once you've read it. And we'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.